I want to get over to Steve Liesman. He's got a very special guest this morning, a special interview with New York Fed President John Williams. Steve.
Andrew, thank you. Yes, I am here at the New York Fed where I've been, we don't know how many years in a row now, but several, with President John Williams for a traditional December holiday interview.
Well, welcome back, Steve.
Thanks. And John, I was just remarking about how great our teams are who schedule this months in advance, knew there would be a shutdown, knew when the BLS would open, and knew that yesterday they would release the inflation report, which they, of course, did not know. But we're lucky here to have you to comment on it. Yesterday, that inflation report came in lower than expected, but it was a little controversial. Give us your takeaway from that report.
Well, a couple things. I think that, some of the data that we're seeing is actually pretty encouraging in the sense on the CPI news. And I think it represents a continuation of the disinflationary process we've seen. And I feel like it's consistent with what we were, or I was expecting. Now, on the headline, though, there were some special factors, some technical factors that really are related to the fact that they weren't able to collect data in October and not in the first half of November. And because of that, I think the data were distorted in some of the categories, and that pushed down the CPI reading probably by a tenth or so. It's hard to know. We'll get some. When we get the December data, I think we'll get a better reading of how much that distortion had, how big the effect was. But I do think that was pushed down a bit by these technical factors.
Sorry to interrupt, John, because this is a big issue right now. Right. Did your army of economists already crunch the data and figure it was pushed down by a tenth? Is that a running estimate you have?
Well, that's just a rough estimate, okay. I'm saying.
Right.
But yes, it is, because a couple of the technical factors. One is, they only collected data in the second half of November when all the sales are on, and that's going to give you a bit of a downward bias. Also, there was some issues about the rent data and things like that. So it's hard to know, but definitely I took some positive signs from some of the categories that weren't as affected by that. But I think that really this is just a continuation of the data we've been seeing, and I'm going to wait and collect some more data in the next month or two to get a better reading of that.
Also, from the Department of being lucky rather than good, and we're 2 days after the jobs report.
Yeah.
And, give us your sense of what's happening in the jobs report and your level of concern with the level of payroll growth.
Well, I think
the rising unemployment rate.
Right. And again, I think we have a similar story as with the CPI. I think the basic signs from the employment report, again, they didn't have the data, all the data for October, but they did have data for November. I think what we're seeing is, we're seeing steady job gains especially in the private sector. So that's good news, a continuation of moderate growth. In the unemployment rate, I think that due to some technical factors, again, because they weren't able to collect the data in October, it probably boosted the unemployment rate in November maybe by a tenth. So I think that if you think about that, the unemployment rate has edged up to around 4.5%. Pretty consistent with kind of what I was expecting. Again, we'll get more data in the next few months to see, those technical factors from the government effects of the government shutdown. Those will fade away from the data. But my conclusion is the labor reports have been pretty consistent with what we've been seeing, especially with this gradual cooling of the labor market. No signs of a sharp deterioration at all.
So put A and B together, the inflation and the employment report. Did any of it change your outlook for where interest rates need to be?
Well, it really, so far that's just a few data releases. Fortunately, We'll get a lot more data before our next meeting, and of course we'll get a lot of data.
Just for the record, you're the one that put out the data-dependent T-shirt. So.
Yes, I did.
So it's a fair question.
Yeah. So I do, obviously I see the data as broadly consistent with the patterns that, I've been seeing, and I think we're consistent with the decision we made to cut interest rates at our last meeting. So I think that, again, none of this data is changing my view of the outlook. I would take some, positive sign from a little bit lower inflation data. That's what we've been looking for, but nothing that's a game changer yet. But we'll collect more data, and I think monetary policy is really well positioned right now to gather more information, see what that's telling us about the economy, the outlook, and the risks to achieving our goals.
So you use that phrase, well positioned, which is a new operative phrase, at least as taken by the market, which means you're probably going to take a pause in January. Am I reading that correctly? Is the market reading that correctly? That's the way the market is priced right now.
Well, I never take a pause in my job. I'm always hard at work and collecting the data, analyzing it, looking for all the signs of what's it mean for achieving our employment goal and our price stability goal. So I don't think of this as a pause or anything like that. I do think the data are telling us that, really we're seeing a gradual movement of, I think, underlying inflation back to 2%, but we're going to have to watch all of the data as it comes in, see what it tells us. I don't personally have a sense of urgency to need to act further on monetary policy right now, because I think the cuts we've made have positioned us really well, and to really try to, I think one goal here is to stabilize the labor market. I don't want to see the labor market cool too far. I want to see inflation come down to 2% without doing undue harm to the labor market. It's a balancing act, but again, I feel like we've got this in a pretty good place.
John, I don't know the extent to which our viewers know that you're one of the world's experts when it comes to understanding this concept of the neutral rate, the rate the Fed would set to not grow the economy, or stimulate the economy, or not cause it to contract. In your view, where are we relative to the neutral rate?
Well, the way I think of the neutral rate is in terms of the real or inflation-adjusted interest rate.
Sure.
And so today, based on a forecast of inflation of a little under 2.5% for next year, that puts the real interest rate somewhere around 1 to 1.25%. So that's in the kind of I would say, in the range of estimates of neutral that are out there. So I think we have moved toward closer to neutral. My personal view, speaking for myself, is that the neutral rate is probably a little bit below 1%. So we're still mildly restrictive in terms of the stance of monetary policy. We still have some room to go ultimately to get back to neutral, but that's not guiding my views on what should we do at a specific meeting. That's more of a conceptual framework to think about it. But clearly, I do think that we've gotten closer to neutral. I still think we're a little bit above.